Hello, welcome again to the episode of the Let People Prosper series. My name is Dr. Vance Ginn. I hope you're having a prosperous day. Well, today I'm delighted to have someone on who knows a lot about the markets, knows a lot about freedom and prosperity, and a lot more. And it's none other than Dory Wiley. Dory, welcome to the Let People Prosper show.
How are you doing, Vance? Thanks for having me on.
Hey, I'm doing well, Dory. It's really a pleasure to have you on the show. We've known each other for a while now, and both Texas Tech Red Raiders, as I'm sure we'll talk about that some as well. That's all right. Guns up. So we've got a lot to talk about. For the audience, let me go ahead and read your bio, and then we'll jump right into it. So Dory A. Wiley is president and CEO of Commerce Street Holdings, LLC, the holding company for Commerce Street Capital, a FINRA member, broker, dealer, and Commerce Street Investment Management, and SEC registered investment advisor. Since co-founding the firm in 2007, his primary focus has been the creation and management of investment funds that specialize in financial institutions and related derivatives. Mr. Wiley serves on the boards and investment committee of CSIM's investment funds. He formerly serves as a member of the board of trustees of the Teacher Retirement System of Texas, an approximately $100 billion pension fund, where he was chairman of the investment committee. Mr. Wiley received a BBA in finance and accounting from Texas Tech University, Reckham, and an MBA from Southern Methodist University. So with all that said, Dory, it's really a pleasure to have you on the program. And like I do with every guest, why do you do what you do every day?
Well, it keeps me out of trouble, I hope.
There you go.
I would say, anything that a person does, if they do well at it, whether that be shining shoes or flipping hamburgers or what we do at Commerce Street, you got to have a passion for it if you're going to be good at it. And the passion, I think, that comes from here is from solving problems. I like solving problems. I like helping people. At the end of the day, when you solve a big problem for a person and you help them, it's extremely satisfying. You get a lot of satisfaction out of it. So that's fun.
Yeah, definitely. And you've been doing a great job of that for a number of years now. What really got you interested in, finance and going in that particular direction?
Oh, I think probably like a lot of people, I started out as an electrical engineering major, and there were no girls in the engineering school, so I left. And there were over 200 in my first class at Tech. So I'm like, I think I want to be a business major. But I've always been interested in finance and the stock market, and I've just always been interested in it. Money, arbitrage, opportunities to do things, to create product. It's a very exciting business. It's extremely fast business. I've been seduced by it since college at an early age, and it hasn't changed a bit. I haven't lost any enthusiasm.
That's great. That's great. And at Commerce Street, what type of investments do you really focus on?
Oh, gosh. We do a lot of things for a small firm. I say we're small. I guess technically we're the largest independent investment bank in Texas. We have an investment bank and then a broker-dealer, and the broker-dealer is the deal business. So think buying and selling companies, mergers and acquisitions. Half of that business is in banking, but we do energy and real estate and healthcare, technology and fintech and manufacturing and what else. And then we work all up and down the capital stack on the private placements, from loans, senior stretch, mezz, preferreds, and then of course equity capital. Most all in the private markets. We don't do a lot in the public markets. On the investing side, we're the fastest growing 401k and retirement planning business in the state. We've developed a niche that beats everyone else on cost and performance, so we're very blessed. And it's less risky to the sponsor, the company. So it's extremely attractive. That's been talk about helping people, with their retirement. That's very exciting. But we manage private equity funds in the banking sector. We probably put $1 billion to work in that sector. We've got a couple $1 billion in what is called small business investment companies. We're basically private equity and mezz that teams up with the SBA arm of the government for a little government partnership. It's a great business. It helps a lot of small companies, helps create jobs around the state. And our investor base in that business is mostly banks. We also do an outsourced CIO business, chief investment business, where we help family offices from either portfolios or portion of their portfolios to manage money. It can be foundations and endowments as well. And that business is growing rapidly. So we do all kinds of things. We help people with investments. We help people either broker them or as a principal. And we do sponsored equity deals too. Sometimes we just see a deal, we're not sure where to go with it, but it makes a lot of sense, so we do it.
Yeah. Sometimes it just drops in your lap. You're like, all right, let's go. Right?
Let's go.
Yeah. And y'all have and you also have an annual meetup, a conference, right?
Yes, we do. We'll do sometimes an annual investor conference. We do an annual bank conference as well. We've been doing quarterly in lieu of the annual investor conference since COVID. We've been doing quarterly investment updates.
Okay.
Like I don't know, a happy hour from like 4 to 6. And we come out and network, and then we give market updates, and people seem to like that. So that works pretty good. It's a little more timely than waiting once a year.
Yeah. Well, good. And I hope the audience will go check it out. It's Commerce Street Capital. A lot of good stuff going on there. Something else, I talk a lot about public policy here on the Let People Prosper show, and how to help people. To your point, and Dory, I've talked about this, but I really feel like this is my God-given calling, is to let people prosper. And so I've been working on that, and got a first-generation college student at Texas Tech, got my PhD in economics to really focus in on that. And then, I worked in public policy for a while. Then I started my Ginn economic consulting, and now I work with like Pelican Institute, and there's a lot of different groups. American Tax Reform, another big one. And I think with your line of work of trying to help people, I wonder, I know the answer, but I wonder how much government may get in the way of what you see as things that, from a financial perspective. Where do you really see some of the hindrances or helps that come from government?
I don't know who said it. Maybe it was Reagan or something. The most feared words were, "Hey, we're here from the government, and we're here to help."
Yeah, that's right.
I'm not sure a lot of good has ever come out of that. Maybe some, probably some safety things or whatever. But business-wise, while well-meaning, a lot of times the unintended consequences can be more problematic than anything that ever helps. And that's regulation, right?
Yeah.
But there's a role for government. I mean,
yeah,
we deal very heavily in the banking industry, and I will tell you the best legislation ever developed to smooth out a business cycle was FDIC insurance in 1934, because it developed confidence in the banking system. And without that, the extreme shocks lend themselves to really big booms and busts. As they used to call them panics, but those panics, back to 1797 and 1937 or 1837 and 1857, every 20 years like clockwork, those unemployment numbers were about 24%. So those were depressions. They were panics. And it's directly tied to the banking system. So, stabilizing that is a very key thing. But other than that, I tend to favor less regulation rather than more. You have to be real careful about what you do. A lot of times government is selling help to get votes when sometimes it's not needed. You have to be careful about it.
Yeah. And on the daily grind, of looking at the stock market and whether it's going up. And I was looking at earlier, at least today, and we're recording this on August 23rd, 2023. S&P 500 year to date's up, about 15%, 15.6%. Here's what it shows. So, it looks good even over the last 3 years. That's up quite a bit, almost 30%. Over the last few years. And, one could argue, well, look, the Biden administration is doing a good job. The S&P 500 is up, but I think people would forget where we were 3 years ago and how far down.
That's the thing. You and I call that, you got a PhD, and I have low self-esteem, CPA, CFA, MBA, I don't know, all kinds of letters.
Yeah.
The last time I checked, most licensed securities guy in the state. And I don't know if it's made me any smarter. I'm still learning every day.
Yeah.
But we call that data mining.
Right.
How good I did. I picked the right deal. Well, it all depends on when you start. It's been a very, very, very questionable economy. If you want to pick on the president's administration, we'd be here, kind of all day. But I would say, we've had a congressional problem for a really long time. We got this fiscal problem. That's a real problem, and everyone throws it in the hat of the Fed, and then they get frustrated with the Fed for raising rates, but they can't control the fiscal problem.
Right.
I'm not sure anybody in the White House can either, unless they want to bring a big hammer somehow. Until we get a handle on that, it's going to be really, really difficult. And the market, amazingly, is actually doing pretty well in spite of all the negative things done either in the administration or with Congress and fiscally. And with inflation, I'm amazed at how well it's held up. And you hit the key thing. The earnings actually have been kind of hanging in there. As long as they're hanging in there, the forward PE ratio is about 20.
Yeah.
It's a little higher than the average, and should make you a little uncomfortable. But with inverted yield curves, and you know better than me, being a PhD in economics, they always forecast a recession, but they always need a catalyst, and we haven't had the catalyst yet. So I don't know what that is.
Yeah.
It's always some unforeseen major event where fear finally enters the equation, and then there's selling upon selling. We all know the massive bets. We run hedge fund portfolios here, massive bets by hedge fund portfolios and whatnot on a 20%, 30% corrective event this fall. And all it's waiting for is the catalyst, and we don't know what that is, but it'll be something that injects fear that we don't have in the market right now.
Yeah.
And as soon as that happens, then we'll get it because the curve says it will happen. But having said that, curve's been wrong for a while now. The market's been wrong for a while now, expecting the Fed to decrease rates. They're not going to decrease rates. They're not Alan Greenspan. They don't come up and mumble what they're doing. They spell it out and say, we're going to raise rates. And the market says, well, we don't believe you. You're wrong, which I find really amusing. They're going to keep raising rates. The market right now says there's an 85% chance that they do nothing in September. And I don't believe that. I think it's closer to 50-50. And we're going to learn a lot with Jackson Hole this week.
Yeah.
That they're still worried about inflation, and they're not shooting for 3%. They're shooting for 2%.
Right.
And we're still raising. Now it may be increasing at a decreasing rate.
Yeah. Yeah.
But it's not going down. So
right.
There's a lot of work to do. They're not gonna cut rates over the next 12 to 18 months, I can assure you. And the futures market and the yield curve disagree with that.
Yeah, no, Dory, those are great points. And some of the things that I look at are, one is the interest rate is important, right? They target this federal funds rate, went from 0 to 5.5% now, the highest since the early 2000s, basically 20-year highs. We're seeing mortgage rates that are soaring. We're seeing 10-year note soaring as well, and car loan rates and all these other things. And the housing market, I think, is going to have a lot of pressure for a while, Dory, because so many people are still locked in to those lower rates. I think I saw it the other day. I think about nearly 75% of mortgages are below 3 or right around 3.5%. So why would you sell your home and get a mortgage rate that's going to be 7%? You wouldn't. And so that's going to restrict the supply at the same time, or the demand, really, how people are going to buy it or not, because they're not going to go out there, but they're also not going to have more of the existing housing market that's out there. And I saw something recently, Dory, I thought was really interesting, is how the new homes are going down in value to be below the existing home price. And we haven't seen that. And that's going to be an interesting other factor in this marketplace. But I wonder what you've been seeing kind of in the housing market and some of those types of investments.
Yeah, it is kind of peaked out. There's been a lack of supply, which has been, depends on the market, right? I'm not sure they got a lack of supply in Detroit, but, we certainly had a lack of supply in the major metro areas of Texas, which we've been very blessed to be in. I tell people, don't think we're so great. We're just the least worst.
Yeah.
Okay?
Yeah. Well, we got work to do too. That's right.
My partner Tex calls it the prettiest horse at the glue factory, but that doesn't sound, overly politically correct or whatever.
Yeah.
But, anyway, having said that, I think we got to watch this housing market. It's going to be interesting. Joe Sixpack can't take a job and move big cities somewhere if he's in a 2 or 3% mortgage, and then he's got to move to a 7.5 to 8% mortgage, even if he got a pay increase. The pay increase has to account for that, because his payment just jumped up nuts. Yeah. And he can't afford it.
Yep.
So then, all that has a ripple effect, as you know. So we'll see. I'm still amazed that this stuff hasn't found its way into the system yet. Now, part of the reason is we're going back to the banking system is credit. And if you go to the 80s of extremely loose time with credit, people were making 100% construction loans, right? And in 2008. Most of the banks, smaller banks, whatever, did construction loans. They'd go anywhere from 80 to 90%, and maybe on future appraised value, right? So almost effectively 100% loan. People don't do that. They have not been doing that since 08. The credit underwriting is fantastic, compared to any cycle we've ever been in. The balance sheets have been fantastic compared to any cycle we've been in. Now, I'd like to see some more capital on some of these banks, and we can talk about that. But for the most part, the system's been fantastic. What we haven't ever had is a 500 basis points rate shock so soon to cause this increase in cap rate, particularly on real estate, right? These real estate guys who don't keep a lot of cash around come back to the bank to renew their loan, and the loan's not 4%, it's now 8.5%, and the cap rate's changed. So now they got to cough up more equity, and the bank is scared, and the bank's going to do a lower LTV. Where's he going to get the money? So that's all coming. That's already in the system. I'm talking to banks now, and they're doing, the regulators are kind of working with them what we call pretend and extend, make some adjustments, extend a loan, do this and the other. Well, that doesn't mean there's not problems. Okay. It doesn't mean that those problems aren't embedded in the balance sheet. It just means it's a little harder to detect them.
Interesting.
And it takes a couple of years to work through.
Yeah.
So you keep these rates, say, up here for another 2 years, which is very viable given inflation numbers.
Yeah.
I think you could see a lot of refinancing. And I spent lunch today with a real estate guy, and he goes, well, my 4% loan, $40 million loan renews in 2025. What are rates going to be then? I go, that's a magic question. I can't see that far.
Yeah.
I go, but if you might want to buy some kind of a swaption, an option on a swap to get the fixed rate in 2025, because the curve tells you rates are going to be lower, right?
Yeah. Yep.
And so you probably have some kind of arbitrage there, because I don't think the curve's been right for the last 18 months.
No, man, that's good. That's good information. And another area that I look at, Dory, is the Fed's balance sheet. So the Fed's balance sheet, as you know, went from 800 billion back before the great financial crisis, and then went up to about 4 trillion. Then it started to come down a little bit in the late aughts, and then it soared, of course, again after when COVID hit, the shutdowns happened. They flooded the markets with money. It went from 4 trillion up to $9 trillion, and now it's back, I think, right around 8 trillion, maybe $8.1 trillion. It's still up, about double what it was before the pandemic. That's a lot of liquidity. That's a lot of money to put into the marketplace, and they're bringing it down some, right? But at a pretty slow pace. And so there's still, for what I'm looking at, is a lot of distortionary measures that are throughout the economy, and a lot of these rates that are out there for the longer term of the yield curve on down, and still mortgage-backed securities, which is a big portion of their portfolio now. And so that is a lot of credit that's out there. And what I've been saying, and on Kudlow and others, is, and I know you're on there sometimes too, is look, or not necessarily Kudlow, but Cavuto. I want to be on Kudlow one of these days. But what I've been saying is, look, we need them to contract that at a faster rate, because I don't see that we're going to get a hold of inflation with how much that Congress continues to overspend. I mean, look, even the CBO, which has terrible forecast projections, they're showing $2 trillion a year in deficits over the next decade. Net interest payments on the debt is going to be about $1 trillion. So that's about half of it. And so we're just rolling over debt. And if the Fed doesn't start to pull that back, which I know will raise interest rates, and that'll cause a larger hit, but I don't see how we'll get a control of inflation. Too much money chasing too few goods. And Dory, as you know, the Biden administration, everything else is raising taxes, and I don't see any sort of supply side economics coming in with the cutting taxes or deregulation. And so I don't see how the inflation is going to come down to back to their 2% rate. And so I wonder what you're thinking about that.
I don't either. And you hit a key thing here, with this Fed balance sheet, compared to previous cycles and whatnot, it doesn't give us a true picture. Right. It's hard to figure out. The Fed's out raising rates, and then they're buying bonds on their balance sheet. You're like, what's the truth? What's going on? Do we really have a market, of free willing buyer and willing seller? What's going on out there to determine what the real rate is? No. We don't. And vice versa is true as well. Yeah. So ideally, we'd like to have no balance sheet at all, so we get a figure and let the market determine everything. The clear point is we don't have the market determining everything, right? So the market being wrong actually kind of makes some sense.
Yeah.
Okay? Also, now, to some extent, I don't worry quite as much as I do about the size of the Fed balance sheet, other than the fact I wish it was not there.
Yeah. Yeah.
I worry more, just like I would a regular bank, about the equity of that, right? Now, what's the equity of the Fed balance sheet? Full faith and credit of the U.S. government. Okay.
Yeah.
That's what I worry about. So, I think a better solution would be is if if we had, I know I'm wishful thinking here, but if we had some leadership in Congress and the administration said, you know what, we are out of control on spending. We can't just go throw money at everything we want to do. We're not efficient at it. We got people stealing money. We need to talk about that. We got people stealing money right and left from the taxpayers.
Yeah.
Taxpayers don't mind paying taxes. They don't like us wasting money.
Yeah.
And they don't like stealing money. Okay. And so we don't have an accounting for our money, whether that be in the military, the Pentagon, social work, climate change, whatever. We don't have proper accounting for all this stuff. And we know a lot of money is missing and it's not doing what it's supposed to be doing. And we need to seriously do some budget cuts. We need to seriously try to balance our budget. Think about this, when you talk about confidence in the system, again, the only reason why the dollar is fantastic is because we're the prettiest shoe at the glue factory, right?
Yeah.
And
Yeah.
technically we're all broke. It's just
Right.
we're less broke than everyone else. So, but if we were to jump out and show some leadership in the world, hey, we're taking steps to balance our budget. Maybe not now, but here's our path to it. And it's important to us. Imagine what that would do for the dollar. Imagine what that would do for the rest of the world. Without that, we get back to the Fed balance sheet. We don't have any equity.
Yeah. Yeah.
Our bank is broke, but I really worry about more. As long as we have that confidence in the system, then that bank, whether it's 4 trillion or 20 trillion, really doesn't matter. It's confidence in the system.
Yeah.
And that's what I'm worried about. That is a more fragile thing than people realize, because we saw that in April. What happened in April?
Yeah.
What? They're not going to cover deposits? Boom, 40 billion runs out the door in less than a day. In 2009, we had that show up in a newspaper, Wall Street Journal. An FDIC employee says, we may not cover the large uninsured deposits. And 11 billion runs out of WAMU, and in 10 days they fail. Now it's instant, because you and I are on the podcast and we get on our phone and move our money, and then we're still on the podcast.
Yeah.
and so that's scary.
Yeah.
That's really scary. So what we didn't have there is what? Leadership. I'm going to be highly critical of the, call it Janet Yellen, Secretary of Treasury. She has one job in a situation like that. She got to step up on Thursday, step into the mic and go, hey, ladies and gentlemen, your deposits are safe.
Yeah.
We cover your insured and uninsured by moving them to safe banks. Okay. So if a bank fails, you don't have to worry about your deposit. We're going to move it to another bank. You don't need a bank run. Okay. That's what we're in the business of doing. And we've been doing that since 1934 through several cycles, 2008, the savings and loan crisis, the Texas banking crisis. Your deposits are fine. Don't worry about it. Everybody that called me all over the United States, I told them that. And yet we have leadership that steps up to the mic and can't spell their name. And they still haven't done it since, right? They still haven't said that. So that is still that confidence is still looming out there for the next problem. So we have that problem not only in the banking system, but if we can't get it right for that, how are we going to get it right for our country?
That's exactly right, Dory. It's one of the concerns, because I get your point about the FDIC and kind of having that backing, but I also, from the flip side of it, it can lead to moral hazard, because then I have $250,000 in there or whatever they're going to cover now. I guess they're going to cover whatever the deposits are, but there's less incentive for me to go out as an individual to see what's on my bank's balance sheets, because I'll be covered.
You can't do it.
Yeah.
You can't. I know people with PhDs and they still can do it. I'm an expert.
That's true. Yeah.
And I know bank investors that still have a hard time doing it. Okay. Now, so banking is different. Does it create some moral hazard? Yeah. We got to cover deposits. Do we have to cover 100%? No. You can still cover the 250.
Because what are they doing now, though, Dory?
Right?
Yeah.
It's about posture. They don't fail on large deposits.
Yeah.
Because it would cause insecurity in the system. But they don't have to come out and change the rules.
Right.
That way we technically still have some moral hazard in the system.
I got you. Yeah.
So it's all about leadership.
Yes.
And that's what we don't know how to do. Yeah. And I understand Biden not knowing how to do that. That's fine. But when I have a Secretary of the Treasury, that's part of your job description. Can you do a 1 or 2 word statement to inject some confidence in the banking system? It's kind of important to your job.
Yes. Not there. Nothing. Well, Dory, I want to talk just a little bit about your time too with the teacher retirement system of Texas. And I think one day, hopefully maybe there's an opportunity for Secretary Dory Wiley there at Treasury one day. I don't know if you'd ever be interested in that.
Well, they'd have to speak West Texan.
Yeah.
I was speaking at a big private equity conference in Europe one time.
Yeah.
When I was done, about 2,000 people there. And a guy come up to me afterwards and he says, I speak 21 different languages. I've known English for 30 years. I can't understand a word you're saying. I said, well, you don't know West Texan.
That's right. Well, just real quick, as we're wrapping up here, with your time at the teacher retirement system of Texas, it was quite phenomenal to see kind of the investment returns and everything that was going on in Texas. And you've talked this before, but there's been kind of ups and downs basically since you left. And I'm just wondering what you've been thinking about that here recently.
Well, let's talk about it. I really enjoyed that. I learned a lot. I think it's 150 billion or so now, maybe bigger. Yeah. But when I got on, we were, I think, in the bottom quartile performance. And then we went through 08 and we finished and we left. When I left in 2009, we were the number one performing public pension fund in the country.
Wow.
And the way we run our business here is kind of the same thing that we tried to do there. We had a wonderful staff. We had some turnover. We had absolutely wonderful staff. We all got on the same goal. And I tell people this every day, whether that be a deal or an investment or a portfolio, either here at Commerce Street or Teacher Retirement System. I'm a risk manager first. Everything you do, you should be a risk manager.
Yeah.
Maybe a politician, right? Be a risk manager. Be a risk manager first. So we define risk, we reduce risk. We should make more money in the long term. If we didn't make more money, it's because we didn't define risk correctly and we didn't measure everything correctly, right? And our performance and our benchmarks. And so those were all very important things. We had a great team, put it all together, and it was a wonderful experience. I really enjoyed doing that. One of the things we do here at Commerce Street is do that for funds, endowments, and foundations that don't have the staff to do that, or family offices that don't have the staff or expertise to do it. We try to bring big institutional mindsets to smaller investors.
Yeah, it's great. And was there specific? Because I mean, you're talking about a massive fund, and now there's still some unfunded liabilities. It's pretty substantial. They've done some changes. They put more money into it. I'm interested to see how much that actually just didn't kick the can down the road versus making it more solvent for teachers and for the taxpayers and everything else in Texas. But what were some of the key indicators that you would look at or things that you would want to do there with TRS?
Yeah, some of the things that I thought, well, first of all, there's an asset side and liability side, right? On the asset side, we can only do so much, So if we're doing number one in the country over the long term, that's all we can do, right? You shoot for top decile, maybe top quartile, and see how that works. But having said that, what can we do in a liability? Now, pension funds are not a perfect vehicle by structure. They sort of depend on people paying into the system, right? So as an example, the city of Chicago was bigger in 1920 than it is today.
Yeah.
It's a shrinking city. The state of Illinois is a shrinking state. General Motors has far fewer employees than it had in 1950. Yeah. Well, if you're counting on employees to pay retirees, there's a numbers game there, and it depends on growing, right?
Yeah.
And if you're shrinking, it doesn't work. Now, we're blessed.
Kind of like with Social Security and others too, right? Those programs.
Yep. So in Texas, we're growing. We have the right demographics. In spite of that, we have some unfunded liabilities. So part of the problem is, maybe it's popular to go, hey, you can retire early, particularly with policemen. I've seen this in California. Policemen, you can retire when you're 35 or 40 or whatever, and you're going to get the last 3 years retirement, and they find ways to pump it up, this, that, and the other, and you're going to get that for the next 40 years. Well, that's way more than they ever paid in the system, way more than they deserve. And then I don't want to get into deserve, but it's just it's not mathematically logical and possible, right? So I have the small theory of we should pay people to work and not to not work. Okay, so you could extend retirement. It changes the numbers directly. Hey, push that retirement age act a little bit. And then teachers like, well, I want to retire early. Well, great. We'll kick in some bonuses to give you some incentive to work, longer term. Because people paying into the system is what makes it work. People pulling out of the system is not what makes it work. So part of it is a design flaw. Part of it is a demographics issue, which we have a problem with. But if we add a demographics problem to Texas, we're going to be as broke as other pension funds, kind of around the country. But we should all get the investment side right. And I'll tell you this, 90+% of pension funds in the state of Texas underperform an index, which means they're paying too much in fees and they're taking too much risk and they're not being held accountable for it. And
those are wise words. Yeah.
A lot of them don't even know, and that's not good.
Nope, not at all. And we have all this ESG stuff and nonsense going on, and they've taken care of some of those issues in Texas, but we see that happening across the country and everything. And in our last couple of minutes here, wrapping up here, Dory, what is your words of advice for folks, maybe in general, but also in public policy? Like if you were looking at this and saying, hey, look, what else can we do that would really make a biggest change possible to have an optimistic future to let people prosper, right? What would you say, Dory?
Well, sure. As you know, I'm a big fan of history. You can see a lot of it on my books back here. And I teach courses in our founding fathers and our presidents and whatnot. I think sometimes we get so, Washington once said, inordinate blind loyalty to a party is the most dangerous thing we have to our system. And we have that. Maybe some people say, well, it's your side or it's the other side. We need to find honor in the system. And I can tell you we have unhonorable people that have sold us out on both sides, and they need to go. And sometimes we're selfish and we go, yeah, but they've been there a while and they got tenure and they bring pork projects to us and this, that, and the other. Then we're part of the problem.
Yeah,
we're part of the problem. So the founding fathers never made us a democracy. They hated it. They called it a mobocracy. If the mob thought murder was good, they'd vote for murder. If the mob thought making the treasury was broke, they would do that. Well, that's kind of what we do. We don't even know who we are. We need to get back and find out who we are. And we're a democratic republic that's actually based on a moral set of values. Highly educated people. That's why there's been close to 300 countries trying to copy our Constitution. They all failed. They were an uneducated, perhaps amoral people. And we've fallen kind of victim to that. And we're going to screw up our system if we don't kind of get back to that. So that would be my humble suggestion is don't complain too much. This has been a problem that's been around forever. It's just we got to get involved and vote for moral people.
Yeah. Well, I love it, Dory, and I love the way you put that. It's always a pleasure to talk with you. And God bless you and your family, and hope you continue to prosper in all your ways.
Same here, Vance. Thank you for having me on. It's always a great.
Yeah, definitely, Dory. Well, for the audience, thank y'all for joining us today. Leave us a 5-star rating and share it with your family and friends. And until next time, let people prosper.